Hello, chart watchers, and welcome to this Friday, March 23rd Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it looks like the selling is beginning to pick up. We had an awful yesterday afternoon. Market went straight down yesterday afternoon. We saw the Dow Jones Industrial Average finish down 700 points. We did get a little bit of a bounce early today, but you can see we have now moved back to the lows of the day. The Dow Jones Industrial Average currently down nearly 100 points. The S&P 500 breaking back below the early March lows, now down 16 points, and appear to be heading for those February lows that we saw back in the second week of February. The NASDAQ also following suit, just now testing those early March lows. That's going to be another key area to watch. The Russell 2000 down 12 today, also following its larger cap counterparts moves to the downside. This one, though, has been showing more of an uptrend, so we'll continue to see whether or not we can get a reversing candle to hold that trend line. The 10-year Treasury yield still in that 2.80 to 2.95% trading range. Breakdown below 2.80 would be bearish for equities, as it would show more and more money rotating toward the defensive bond market. Volatility index, big breakout yesterday above 22.5. That has me very worried in the near term. Volatility today up another 4% to the 24 area. Energy has been the best performing sector over the last week. And you can see on a relative basis with the market selling off, you can see the Dow, the S&P both dropping. Energy has actually just been going sideways for the past couple of weeks, so it's showing a lot of relative strength as the market drops. Technology, on the other hand, after leading on a relative basis the last couple of weeks, has been performing horribly on a relative basis, and it is making a very significant breakdown, in my opinion, around that 66 level. Unless we get a reversal this afternoon, it looks like we could see more selling in technology. Defense stocks having a very strong day. I know Lockheed Martin was up near the top of the leaderboard today. And there were a couple of others, I think, as well. I think Raytheon may have been having a strong day, and some others in there as well. Aerospace did make an earlier bounce, pulling back. One of the big reasons, Boeing hit support just below the 320 level, and we saw Boeing bouncing off that support level. Yesterday, I was talking about Micron possibly moving back down to test price resistance at 50. It seemed almost impossible when it was trading up near 60, but they did report earnings last night. As expected, they topped expectations. Top line was great. Bottom line was great. Stock down 7%. A lot of it already built in. Technology getting hit. Micron being slammed. It's going to be really important technically for Micron to hold on to this rising 20-day moving average. If it fails to do so, we could see that $50 level tested sooner rather than later. And after that lengthy introduction to the market, let me bring in Aaron. How are you doing this morning, Aaron?
I'm doing quite well this morning. We got the rain we needed yesterday, and it looks like it'll clear up here today. I'm hoping.
Did you have any fallout from mudslides? Because I heard that was a big threat out there.
Yeah, for us, it was a nice light coating, but I know that in the hills a little bit lower from me, the police and fire were sitting out there waiting yesterday, just sitting there waiting, and but nothing ever happened. So that was good news. But I think up north they're having some issues. So,
well, of course, I'm in the northern part of South Carolina, about 20-30 minutes south of Charlotte, North Carolina. And I tell you what, I've gone out twice. I always go to Starbucks, and I do my blog every morning at Starbucks, get my latte. I don't know, I just have this ritual. I'm very, I don't know, I'm a creature of habit. But anyway, I go out in the morning, and for the second straight morning, I've had ice on my windshield. I'm not just a little dusting of ice. I mean, thick ice that I have to let the car run for a while.
Yeah. Do you have one of those picks that you can use? I think back when I used to live in Jersey, I had something that, you could kind of slam on there and break it up and then scrape it. Oh my gosh, that's nightmares right now. Never, never again.
I moved from the mid-Atlantic area down to the southeast. I'm in South Carolina. There's a reason why I guess there's a South Dakota, so maybe I shouldn't say that. But South Carolina is in the South. I'm not supposed to be scraping ice in the mornings, especially as we head into spring.
Yeah.
But oh well.
Well, it is what it is. Market is certainly having some rainstorms.
Yeah, there's a lot of ice on the market windshield this last couple of days for sure.
Yes.
We got a lot to talk about, so I'll let you get into the announcements and the agenda.
Absolutely. So this next week, since today is Friday, Tuesday we'll be doing everything stock charts. You're going to get some sort of wonderful tip or understanding of something new on the site. And Mark Young from Wall Street Sentiment. .com will be here to talk sentiment. I'm very excited to talk to him on Wednesday. Arthur is going to be here on Thursday, so that's just going to be great as well. And looking forward to that. And then finally, Friday, the market will be closed. So I'm sorry, but we will not be here doing our program. But today, what are we doing? Well, we're going to start off with Tom's workshop. After our technical news, we're going to find out reasons to sell. We'll finish with that and go right into the 10 and 10 to 1. And our first symbol is Ciena Corp, CIEN. And finally, I will give you my sentiment update so you can see what's going on with that. And I'll explain how sentiment works in the process. And with that, let's go, Tom. Let's get this party started. Technical news.
Yes. All right. Let's take a look here. A lot to talk about. I'm going to get a quick update, make sure I have the latest here on the 10-year Treasury. And you can see we are down just a little bit today. We were up a little bit earlier, so we've reversed, trading at the low end of today's scale on the TNX and getting close to a very key short-term support area, 2.80%. A couple of economic reports out today. We did see February durable goods come out up 3.1% versus the market's expectation of up 1.7%. February durable goods ex transport, so excluding those transportation areas, up 1.2%. Market expecting up 0.6%, so a doubling there, which was nice. And then at 10 a.m., February new home sales came in almost as expected, a slight miss, 618,000 units versus 620,000 units. But, and this is a pretty critical but, January was revised almost 5% higher, from 593,000 units to 622,000 units. And as a result, we have seen some stabilization of late in some of the home construction stocks. And that's something that I would look to possibly continue in the future as we're starting to see a little bit better reports on the housing front. But we'll talk about that a little bit more in just a minute. I do want to go into a predefined set of charts that I prepared for today. And so let's take a look at those. And first, I want to show you on the Dow Jones. Now, this is going back. I looked at where we were on February 26th at the close. That was the reaction high that we saw across all of the major indices, and where we closed yesterday. And you can see here on the Dow Jones, we're down about 6.8% before we go into today's action. Now, if I move forward, go through the S&P 500, you'll see we're down about 4.9% from that same time frame, from February 26th through yesterday's close. Move on to the NASDAQ, down 3.4% during that period. And then finally, the Russell 2000, down less than 1%. And, you know, I've talked a bunch about the fact I think the dollar is going to go higher, and maybe the market's anticipating the dollar moving higher later this year. But I actually think maybe it has more to do with the trade wars that everyone is fretting about right now. The fact that we could have a war on trade with China. And, you know, President Trump came out and announced, you know, that we're going to have this $60 billion deal with China on tariffs and so forth. And China this morning came back and said, well, you know, we're gonna do $3 billion kind of as a little bit of a retaliation. And there was a lot of speculation that maybe their response was so minor because they want to try to move to the negotiation table or whatever. But I think what the market is saying, the way everything's been performing, is when you think about the Russell 2000 is made up of much smaller companies that do almost all of their business, in many cases, all of their business domestically. And these companies would not be impacted nearly as much by a trade war as companies that do business in China or in Europe. And as a result, I think that's why we're seeing some of this money rotate. Now, today we are getting further weakness on the Russell 2000. Maybe some of that that relative strength will start to erode in the coming days. But I think the more the market worries about trade wars, I wouldn't be surprised to see the Russell 2000 outperform, especially if we do get a bottom, start to move higher. My guess is that the Russell will move higher faster, but we shall see. Let's take a look at the home construction index. Mentioned this, and you can see on the home construction index that we broke down and we've been trying to get back through 875 with no success. On the most recent lows, lower prices, higher PPO. That means we could see a 50-period test and a PPO centerline reset. Those are the blue arrows right here. And if we do get back up near that 875 level to test the 50, that's going to be a pretty significant area of price resistance as well. So that is a critical area in my view on home construction. A breakout on a closing basis above 875 would be very bullish. In the meantime, these recent lows are going to act as support. Moving on, KB Homes. I'm going to get back to that home construction index in just a second, but KB Homes reported today, and they missed on their top line, but they beat pretty easily on their bottom line. I think they came in at 40 cents. The market was only expecting 30 cents, but they did come up about 2% short on their revenues, and the stock gapped up, got up to this area of resistance on that initial bounce, failed, and so far putting in a pretty ugly black candle at the 50-day moving average. So I don't know, short term, again, we want to watch the high today on KBH, the recent low. That's a trading range that I think is going to be very important to see which way KBH breaks, whether we break to the upside or downside. Now, here's another chart of the home construction index, and this one is for all of you Fibonacci lovers. If you go back to the bottom 2 years ago on the home construction index, we've had a huge run. And if you notice, and this is the red Fibonacci coming across here, if you notice, the first initial pullback under Fibonacci, 38.2%, is 796. And that's almost exactly where the recent weakness has fallen. Now, on these attempted recoveries, you can see we haven't been able to negotiate that declining 20-week moving average. So I think right now we're kind of trapped on the home construction between about that 800 level and 850 that I was just talking about on the, or 875, I should say, I was just talking about on the daily chart. I think here on the weekly chart using Fibonacci, I think that also confirms that this is a pretty significant area of support and resistance, very significant trading range to continue to watch. The other Fibonacci that I used, and I watched Arthur do this on the show, where he picked a different bottom, which here I think is pretty significant. And just showing the strength that we saw for about 14 months in home construction. And note that the 38.2% here comes down almost to that same level. I think I said 796 on the red, which is true. But here the blue line comes down. This is 38.2% off of this rally, and that comes in at 819, 820. So Arthur referred to this as like a cluster of Fibonacci support. And I just thought it was interesting pulling up this chart using those two Fibonacci retracement tools here to show that there is really significant support from a Fibonacci perspective at this same area. So keep this in mind as we go forward on home construction. A lot of folks are looking to home construction and saying it's over, interest rates are going high. Well, they are on the move higher, but I think they're still near historic lows. I don't think the interest rates are at a level that are going to slow home construction if our overall economy continues to expand. So what I'm looking for is a break back to the upside above that 20-week moving average. But in the meantime, I think the trading range is pretty well identified and defined. And as a result, let's see which way we break. Let's keep moving here. Micron reported earnings today. Talked about this one yesterday, that it could possibly go all the way back down to this 50 level to test this breakout. I know yesterday probably didn't seem too likely, but with today's low dipping below $54, we're not that far. One more bad day and we'll be there. So Micron did report solid revenues and earnings as I expected, but we talked about buying on rumor, selling on news, and I think right now this is a sell on the news event for Micron. Cintas. Well, you want to, if you're going to play by, fire, holding into earnings reports, you saw the downside with Micron. Here's the upside. Cintas comes through, beats on top line, beats on bottom line. I think they beat by about 10% on their bottom line, if I'm recalling correctly, $1.37 versus $1.24. And we've gotten a nice rally in Cintas as a result. A couple of others here. At Home Group, another huge rally off of big volume. This company came in, reported better than expected revenues and earnings, 50 cents versus 35 cents on the bottom line. That's what's creating this huge move to the upside here. Nike reported just kind of range bound. We're getting a little bit of positive response to the upside, but not a whole lot. The overall uptrend does remain in play for Nike. And I mentioned KB Homes earlier. So I'm going to turn it over now to Erin and let her go through a couple of upgrades, downgrades with you.
All right, sounds like a plan. Let's go ahead and get that started. All righty. Here we go. One downgrade today for you. Actually, I have a 2, and I don't know why that didn't update properly. Let's try this again. There we go. 2 downgrades and 2 upgrades today. I'm going to start with the downgrade BPL Buckeye Partners. And you can see we've had a really serious breakdown right now. We'd already seen a touchdown there below, managed to close just on that area of support yesterday, but today and on the news possibly, we see a serious breakdown here. It's actually below the low back here in early 2016, and now it's heading toward an area of support at about 36, I'd say. With the PMO, I think the good news here is the PMO is in that oversold territory, and this is some support that we could probably see. This is a weekly chart, just so you all know. I will show you the daily chart really quickly, but I couldn't get enough information off of it, and I suspect you'll see. We've just been in such a downtrend on this particular stock. I really wanted to see what the support and resistance areas were. And so I moved to that weekly chart. So that's why we did that. But you can see again, the PMO, the daily PMO is also in oversold territory. However, it's going to, I think price is going to have to go down and touch that area of support that was on there on the weekly chart. Nutanix, this was apparently Goldman Sachs removed this from their conviction buy list. So it's kind of a downgrade, but not the typical ones that we talk about. And you can see that breakout, it turned out to be a false breakout. And then we got this news. And of course, the stock has now started to fail. This was a descending triangle, but that breakout might have gotten a few people excited. But I can look at this and see we've got that long upward tail there. So I think there was some possible news in there when you look at that. But look at the volume. It's people, they were already starting to get rid of it earlier, and now it's just continuing to sell. And I don't see any good support here until about $40. So maybe a shorting opportunity, but I'm not liking that as a possible bottom feeding. I wouldn't be looking at that one. We've got Dexcom. This was an upgrade today, and really nice stair steps here on flags. You can see this flag executed, and now we've started to form another flag. And actually, if you look in the thumbnail, you can kind of see an ascending triangle there on that flag, and you know the expectation is breakout, and that's what we got. The question is now, where are we going to be looking for overhead resistance? I did not write it in here, annotated in here, but it's all the way up here to $77.50 or $80 at this point for Dexcom. The PMO is a little bit overbought, which could be a bit of a problem, but I'm liking this volume pattern on the OBV, and look at the scooter, just took off. So relatively speaking, it's got a lot of relative strength. General Mills also upgraded today. We had a really serious gap down yesterday, on Wednesday, and continued to trade and fell even further. So it's interesting to see an upgrade come through here for General Mills, but this might present an opportunity. But let's go look at the weekly chart and see where that support level is right now for General Mills. And yeah, as you can see, in fact, I'm going to go ahead and annotate this very quickly, and then I'll, whoops, I didn't want that. Go over here. There we go. So you can see that's some serious support that we lost there this week, and it's continuing lower. Where's the next area? Well, let's see. I could see these tops and those lows. We've already passed below that one. So the next area I'd be looking at is right here around that $40 range. Hopefully, with this upgrade, we'll see it get itself back up above that broken support line. But, you know, even with the upgrade, I would be a little bit cautious here as far as General Mills. It doesn't look like it's ready to change. And look at this. We have an 11% drop on a day that it got an upgrade. So some serious problems going on in there, I would say. All righty, and that's it for the upgrades and downgrades. So I'm going to pass it back to you, Tom. Are you ready? Everybody else is waiting with bated breath, I'm sure, for your upcoming Reasons to Sell workshop.
Yes, I am ready. There's a lot of reasons potentially to sell in, as a trader. I do want to just kind of lay the groundwork here a little bit before we get started. Actually, I shared the wrong thing there. There we go. So here you have essentially the homepage of stock charts, but I just want you to think for a minute or so here as I go through. First, I want to make sure that my charts came up. Did they come up okay?
Let's see. Yeah. Oh, wait. Yeah, you're on the member dashboard. Yeah.
Okay,
we're good. We're good.
Okay. Yeah, I think it's important, number one, to think about, before we even get into the reasons for selling and so forth, you have to understand and think about what your purpose and goal is in trading stocks. For me, it's like a business. I'm doing it to make money. If I can't make money, and I not only do I want to make money, but I want to beat the S&P 500. That's my benchmark. And because I know I can just put my money in the S&P and go golfing in the afternoon and not even worry about the stock market. So if I didn't think I could beat the S&P 500, what's the point of me, going through setting up all these chart lists and going back and reviewing everything at Zacks in terms of earnings and looking and running scans and trying to come up with the whole purpose of all of this is to try to give myself an advantage to beat the benchmark S&P 500. We have a lot more information at our disposal now than what we had 10, 20, 30 years ago. This is just stock charts, just the use of the site, the tools and all the features. None of this was available. As Aaron will tell you, and Carl when he was on here, and many others, 30 years ago, a lot of the stuff that is done at stock charts was done by hand. I remember doing things by hand as well, charting different things. And so we have a lot more tools at our disposal. So I use all of this to try to beat the market. If I can't beat it, then there's really no point in going through all this. Otherwise, it's more, if you think about a business, if you're getting into business and your goal is not to make money, then it's more philanthropy than it is, an entrepreneurial, adventure kind of a thing. So when I look at trading, my idea and using a business as an analogy is, if my employees aren't doing their jobs and you're running a business, you really have no alternative but to find new employees. If you have products that are not selling or are selling at profit levels that are not sustainable for your business, you either got to figure it out or you're not going to be in business for very long. Either you need new products or you need ways to market them differently so that you can sell them at higher profit margins. When I look at the stocks I own, I look at them much like I would look at a product in a business or an employee that's working for me. If my stocks aren't working, I have to get rid of them. So then the question becomes, okay, what are those reasons? What are those reasons to sell? Why would I get out? Reasons to buy are always easy. Somebody tells you to buy. You might listen to Market Watchers Live and like what Aaron has to say or what I have to say or maybe what a guest has to say about a stock or an area of the market, and you just go pull the trigger and boom, you're in. And life is great because you're going to make money. But the problem is that you don't always make money. Things go against you. Conditions in the market change. Some of the basic concepts that you believed when you bought the stock no longer are in play. And as a result, you have to be willing to change your thought process. Now, for me, there are a number of reasons why I would sell a stock. The very first one, and I already talked about this earlier today, let's bring up Micron. Earnings. I don't hold into earnings. I'm not going to say I never hold into earnings, but it is very rare that I hold into earnings. And the idea is I'm trying to manage my risk. How can I possibly manage my risk if I'm going to play that roulette wheel with earnings? Has management performed as I expected? Even if they have, in Micron's case, I think their report was excellent. But look at the move that Micron made heading into earnings. There was already a lot. This stock rose from 40 to above 60 in 5 weeks. The market cap of Micron went up more than 50% in 6 or 7 weeks. They have to blow those earnings out of the water. And even if they do, you're not guaranteed you're going to go higher. Now, my perspective, I'm a shorter term trader. I'm not a day trader, but I'm a short term trader. And if I buy into a stock and I have Micron fall like this, where I'm down 10% in 2 days, that's hard for me to recover. So that kind of risk, holding into earnings and simply letting that roulette wheel go round and round, is not something that I feel very comfortable doing. And doing it with X percent of my portfolio, no, thank you. And again, that's just my own perspective on trading. Now, some of you may be longer term buy and holders. I know that there are a lot of folks that do very well in the market that will position trade. They'll hold their positions for a long period of time. And as long as that position continues to perform well, they hold it. I mean, when you look at this last move in Micron, it came after we had a pretty big sell-off back at the end of November. Micron fell from 50 down to 39. That's a 22% decline in 7 or 8 trading days. If I had been holding, I probably would have been out. I'd have been stopped out. Those who are position trading, maybe looking at a longer term chart on Micron, would say, look at this. What's not to like? I'm holding. I'm going to hold through earnings. I don't care. The selling last couple of days, this is just a blip on the radar. So again, it comes down to your own style. And I just throw that out there because those of you who maybe have a longer term time horizon may not agree with some of these reasons that I bring up, and that's fine. Everybody's got different strategies and styles. But earnings is a big problem for me. So Micron, I don't like this kind of a surprise to wake up to. When I talked about CTAS, that was a positive one. Yeah, I would love to wake up and see my stock up 4%. Or earlier today, it was probably up more like 7%. That would be wonderful. But then you also have, I just pulled up one that I know had reported a revenues miss, and this would have been back in February. Look at OMC. I always hear people talking about, wow, look at the stock going up. It's gone up from 71 to 82 in the 7 days before earnings. They're going to have a great report. I'm going to jump in. Omnicom the next day reported revenues that fell short of expectations, and the stock went from $82 back down to an intraday low in 75 and change. So it's probably down about 8% intraday. And you can see the selling has continued after losing the 20-day moving average. It has failed to get back up above it and continues to drop. All of a sudden, that huge move that you thought was so bullish for the stock, a little more than a month later, we're all the way back down to where we were. And so there's a lot of that short-term movement up and then simply coming right back down to give it away. So I try to pocket profits when I have the opportunities. So earnings is number one. Number two for me, reversing candles. We talk about this all the time on the show. As a short-term trader, I don't know how you can avoid ignoring candlesticks and some of the signals that they provide us. I'm going to give you a few examples here. Let's talk about a bearish engulfing candle. One of the most widely traded and well-known stocks, Apple. Take a look at the top, what just happened. Now, I'm not saying Apple is a horrible stock because we had a reversing candle. But what I'm saying is if you're a short-term trader and you saw the stock go up 4 days in a row and break out and then put in a reversing candle, I'd be looking at least for a pullback to the 20-day. As a short-term trader, do you want to hold that over the next 3 days? Drop from 180 down to 176? I mean, if you're okay holding for $4, coming back down, because that's what I would have been looking for. Now, we actually broke below that level, but with a breakout and the PPO rising, normally what I look for is a 20-day test. So if I get a reversing candle, I'm likely to consider taking my profits right there and seeing if I get pull back to the 20-day. Apple was one example. Let's take a look at another stock. This one isn't as widely known, RGA, which is Reinsurance Group of America. And let's take a look at November. Look at this high. Beautiful move up. 8 straight days where this tree is going to grow right to the sky. Well, there's a bearish engulfing candle at the top. And about, 3 weeks later, we had given up much of those gains. So if you used that candlestick as a signal to sell, you could have booked almost all of those profits and simply watched as RGA fell back. Another one on this particular chart, check out January. We came all the way back up, tested resistance, and did it again. Put in a reversing candle. And to me, a reversing candle is even more significant if you have heavy volume, because to me, that's showing that there is market maker participation. Here, you can see the volume was very heavy on this reversal. Same here, one of the heaviest days leading up. There was a big, big reversal there. So I think you got to be careful when you see these reversing candles, become part of the chart at a major resistance level like this. Anytime I see it, I'm concerned. But if I get it at a price resistance, that's 2 reasons to sell. And I'll talk a little bit more about price resistance later. So there's a couple of examples there. I'm going to give you a personal example, not so much of a reversing candle, or not so much of a bearish engulfing candle, but this was a stock that I traded, and it got near resistance, and I didn't get out, and ended up selling yesterday at a loss, and I'm still kicking myself over it. But here was ADVM. I mentioned this a while back when I was going through one of the scooter reports. I noticed ADVM off of that. And the stock, I just love this move to the upside, the heavy volume coming in, and the consolidation. It was actually, I think, on March 1st when I got this reversal after putting in that tail below the 20. So I want to say I got in around 675. And I know here, when it came back down, I added at 650. It was on this move right here at 650. And the reason I did that was I had an inverse left shoulder, neckline, head, right side, and when I came back to 650, I essentially was putting in that the right shoulder to match the left shoulder. So I was going to keep a fairly tight stop. Look at what ADVM did over the next 4 days. The stock moved all the way back up to 805. I don't even have to pull that candle up. Believe me, I know exactly what that high was that day. I had my order in to sell at 815. And basically, it was just a little bit below that prior high. We came back down, and I've talked about this many times. Look at these tops, how they form with these tails. This one, and I was looking at it, I remember it vividly at the close. I was breaking out above these prior highs. Check out the volume picking up, but I had the long tail at the top. Now, the smart thing to do would have been to at least sell half, but I wasn't very smart that day. And then I watched the next day a bearish engulfing candle form. And then, of course, the next day lost the 20-day moving average. This is how sometimes you just kind of let your emotions get the best of you. And I'm sharing this with you because it was a big mistake that I made and ended up getting out yesterday toward the close when I had a close below the 50-day moving average. Now, it's trying to rally back today. I don't know. Maybe it goes all the way back up. My point is I didn't want to, breaking down below the 50-day, I didn't want another move down here to 6. I just cut my losses. But I turned a very profitable trade into a loss because I didn't follow the some of these rules that I'm talking to you about. So certainly, I continue to pay tuition every day. Let's talk about shooting star candles. All right, so that was bearish engulfing. Let's talk about shooting star. Amgen. Let's take a look back in January. Look at this move to the upside. Here's one. Beautiful move up. Long tail to the upside. Put in a shooting star. It's like an upside down hammer. And now this didn't result in any kind of huge sell-off, but we pulled back for 2 days. As a short-term seller, could have easily gotten out at above $1.90, $190 that is. Could have gotten in a little cheaper or just been out altogether, but we bounced back and then right at the top put in another one with a long tail to the top off of an uptrend, printed that shooting star candle, and that one led to a lot more selling to the downside. Of course, that's when the overall market fell apart. But I think, Amgen, very important. Anytime you get these shooting star candles, false breakout. I see another one here. You can see the false breakout where we had tops coming in at about 190, 191. Look, this day we got up to 192.5, just above it. Came back down, failed to hold it, and then back down again. So there are definitely, anytime you see these long tails to the upside, that bothers me. If you look over here, here was a top. 2 long tails back to back. These are important. Here we made this move. Look like, okay, intraday, if you'd looked at this candle and saw this huge bullish engulfing candle, you'd have been really bullish. But by the close, we had failed to hold the rise back above the 20-day moving average. And look what happened the next day. So you've got to pay attention to these reversing candle. I think that they can save you a lot and provide some sell signals when, you know, your brain doesn't want to let you sell. I think selling is the hardest part in trading. Buying is simple. Selling is the hard part because there's so many different things that your mind is thinking about. And there's so many reasons why your mind is telling you to stay in that stock. Or what if it rebounds? What if it does this? I'm in a strong group. I'm breaking down, but I'm in a strong group, so I'm going to hold. There's a lot of different reasons, but the key, and we talked about this a little bit yesterday with that poll, is price action. I mean, price is really important. So if you fail to make these breakouts and you get these reversing candles, you need to pay attention. Next up, the dark cloud cover candle. The dark cloud cover candle is very similar to bearish engulfing. It's like a junior bearish engulfing. It doesn't quite engulf. So let me pull up ADI, analog devices. We'll go into January. Right here on the top, that's a dark cloud cover. So bearish engulfing would have required it to come back down and completely engulf that prior day's candle body. In this case, we only made it back about 2/3 of the way down that body. It has to be at least a half. In this case, probably 2/3. That's a reversing candle. And as we topped and continued to move lower after that. Check out the most recent high. What's that? Bearish engulfing candle. Long tail to the upside, finished near the low, completely engulfed that prior day. In this case, volume picked up. Let's keep moving. Black candles. Another reversing candle we got to pay attention to. ALXN. Look at this big black candle. So what is a black candle? You know, you see all these red-filled candles. What's that black-filled candle? The difference is that a black-filled candle closes way below the open. That's why it's filled. But it closes above the prior day's close. These red-filled candles, the close is below the open, but they close they close lower than the prior day's close. So that's the only difference between a black candle and a red candle. They're both bearish in my view. You know, everything else, not considering anything else, just looking at the candlesticks. If I open at a certain price and I close lower, that's bearish. I mean, that requires selling. So, but a black candle off an uptrend many times can be a very significant topping signal. In this case, look at the volume. I don't know what came out on Alexian. Maybe it was a drug result. Maybe it was their earnings. I don't know. But here you can see the gap up. Everybody was excited. It was at 122 and change, gapped up to 137, and came back down and closed at 127. $10 reversal. And look at what's happened since. Always pay attention to these reversing candles. Next up, let's go to price resistance. Price resistance is essentially where prices have been in the past, and we simply can't move above. We try to move above. We go up, we test it, but a lot of times we'll fail. Sometimes in an uptrend, in a bull market, I shouldn't say sometimes, in most cases, you're going to go through resistance. But many times it's not without a fight. That's where selling has been in the past, and as a result, that's where you look for selling potentially again. So when I'm trading a stock, if I buy it at support and I move to resistance, I'm usually gone. I normally am not looking for that next breakout. If it happens, great. If it breaks out and it comes back down to support, I might get back into it. But I am not going to assume it's going to go right through. So let's take a look at ATVI. This is Activision Blizzard. And when you look at, let's go back to, say, look at February 28th. Here, we had this high. Let me annotate this, just make sure you can see it. All right, so there's the high close. Now, I'm always looking at closes. I'm looking at candle bodies as opposed to intraday moves. Now, to me, would have been even more bearish if we had put this intraday high in above this one. because that should have attracted new buyers. That's in breakout territory. And then if you go back down and fail to hold, usually that is not a good short-term sign. But in this case, we broke out intraday above that prior high candle body, but we came back down and closed. And this is what I was talking about with Apple, where I expected it to come down, test the 20-day moving average, and then bounce back up. Because in this case, we were coming off of a PPO centerline test. The momentum was starting to accelerate again with the PPO rising. So the failed breakout, to me, is just a short-term reversal. Here we go back down to the 20-day and then back up again. Well, what does that mean? Well, from a short-term perspective, it means I could potentially have sold at 73 and bought back at 71. That's a $2 difference, which is almost 3% in 2 days. That's a big deal to a short-term trader. So rather than just say I'm a short-term trader and see a failed breakout and ride it back down, which I did in ADVM, by the way, in this case, I could have gotten out when I saw that false breakout and gotten back in $2 cheaper if I really liked ATVI. And then I could have placed a pretty tight stop on a close below the 20-day. So that's where, again, from a short-term trading perspective, this can make a big, big difference. Another one, let's take a look at Ross Stores. This is one of the stocks in the NASDAQ 100. And check this out. Now, this isn't taking out a price resistance, but look at that candle right there with this long tail above the 20-day moving average. It looked like we were after a big sell-off, gap down on heavy volume. It looks like we're breaking back up above the 20, and then we fail. And what do? Next day after that failure, stock's down more than $2. Again, could have been avoided. If you're in and you're expecting that this is going through the 20-day, maybe back up to challenge these recent highs, that reversal is pretty significant. Let's keep moving on. What's another reason to sell? How about a negative divergence? Let's take a look at CHTR, which is Charter Communications. And now this is a very slight negative divergence and probably one I wouldn't have been too concerned about until that bearish engulfing candle formed. Here you can see we broke out in early February with the PPO slightly lower. So you're breaking out with a negative divergence, but you have high volume. So I tend to ignore negative divergences with a high volume breakout. But if you're going to break out, you need to hold it. And you certainly don't want a very heavy volume reversing candle coming in with a negative divergence. That is usually the kiss of death, and not just looking for a 20-day test, but I look for a 50-day test after that. And you can see that CHTR, after coming back down, even if you waited till the end of the day and looked at this candle and said, wow, bearish engulfing candle, negative divergence, I better get out. 372. 3 days later, you were at 350, which is $22 or about 6% saved by seeing that warning sign. Recently, might as well talk about, here's a reaction high on CHTR, 365-ish. 2 weeks ago, we got to 370 intraday. Failed to hold that breakout area. And look what has happened since. And off this uptrend, printed a dark cloud reversing candle. And since we've seen selling. Now, it looks to me like we're probably going to move back into this 310, 315 area where we've had prior support before. But this reversing candle came in at 350. No need to hold it all the way down to this level. So again, a negative divergence, especially with a reversing candle. In my opinion, you sell, ask questions later. Another possibility for sale is if you happen to be in a stock. I like to be in stocks mostly with PPOs above the center line. But here's an example of one that maybe has been selling for a while. Had a negative PPO. You can see here, BMRN, negative PPO. But here it comes back up. And look at it. It's at the 50-day. It's right near some key resistance. I'm going to annotate this one so that you can see the important resistance that is drawn here. After this move down, reaction high fails at 87. We gap above 87. We hold 87. We gap down below 87. We fail at 87. Hopefully at this point you realize 87 is pretty big technical level on BMRN. Well, a couple of days ago, we went all the way back up and we hit this 87 area. Now, again, you might look at this and say, wow, we're getting ready to break out. And if you want to play that game and trade it and hold it and hope it breaks out, I wish you luck. But in a situation like this where you've got a stock that has been downtrending and the PPO is below the center line, we came back up and essentially failed at that center line on the PPO and started to roll back over. So I think when you've got a weak stock and you're in it and it makes a bounce back up and you get that center line test, that can be a key area to sell. All right, low volume breakout. This is another warning sign in my opinion. And in this case, I'm going to take a look at Costco back in January. Let's pull up Costco, late January. Look at this push to the upside. Notice the volume, very, very average at best. I mean, we had consolidated for a while, getting a big move to the upside. Yeah, volume ticked up a little bit, but that is not, in my opinion, confirming volume to support this breakout. This is confirming volume on this breakout. This is confirming volume on this breakout, but this last one, I don't see it. So this is a warning sign. If I see that and then a failure to hold the rising 20-day moving average, I would be out. I don't like that at all. Let's talk about stops being triggered. I mean, this is a big one. Yesterday, I got stopped out because of GWRE. I didn't like it closing back below the 20-day moving average. I saw the hammer a couple of days ago. I actually got into GWRE. I think this was actually even my Monday setup from Monday, but conditions have changed. I do not like that pullback. Well, not even a pullback. That is a outright selling below the 20-day moving average. At the most recent high, the PPO is rising. When we come down and hold that 20, I expect it to hold. We got a nice hammer, started moving higher. So at that point, I did not want to go back below the 20-day moving average. So I had my stop triggered, and out I went with a loss on GWRE yesterday. Volatility. That's a reason for me to sell. Sometimes I may like my stocks, which I sold stocks yesterday that I still liked. And I did it because volatility closed back over a key level. We broke out above 22.5. And I know historically that when you break out on the VIX, selling can escalate very rapidly. And technicals, a lot of times you can throw right out the window. Price supports don't hold. It's like a hot knife through butter. And down we go. The VIX rises and the stock market sells off. We saw this here. We got an early warning back in February when we broke out above all these recent highs on the VIX. We moved through that key 16, 17 level that I talk about, and it was on that very next day. This, I believe, that was a Friday. So on February 5th, if you take a look at the S&P 500, that was the day the S&P. This was when the VIX broke out on the 2nd. The 5th is when we saw the selling. And look at what happens and how fast you can sell off. So sometimes it's not even related to the stock. It's related to the environment of the market. And when you've got a high volatility environment in the market, it is pricing in very wide swings. And again, getting back to what I said at the very beginning, if I'm trying to manage my risk, how can I possibly manage my risk with these kinds of swings in the market? I think the best thing to do is let the market settle down, sit on the sidelines. And some might say, well, short. If the VIX is moving up, you should short. Well, look at the reversal. I mean, you're moving down. The very next day, we gapped down, and we had a huge move back to the upside. And the following day, we had another big move intraday. The emotional toll that it takes back and forth of trying to figure out which way the market's going to go next. Again, I'm going to say no, thank you. I'm not interested in trading that kind of market. Also, the time of the month. I talk a lot about historical tendencies, seasonality. The 26th to the 6th is very bullish. Monday is the 26th. So historically, we'll start getting some tailwinds on Monday. But we right now are in a period, the 19th to the 25th. This is the worst time of the month on the S&P 500, dating back to 1950. The annualized return from the 19th to the 25th is 7.71%. And a negative 7.71%. The S&P 500 since 1950 has averaged going up 9% on an annual basis. So the 19th to the 25th, you're talking about being 17 percentage points below average from that period. And a lot of it, in my opinion, has to do with options expiration. The third Friday of the month, right after that week after options expiration, in my opinion, is a time you want to be really careful in the market. So if the market looks weak as it's heading into that period, I'd be careful. It's another one of those external influences that might trigger selling, even though my stocks might not look bad. And then finally, the last thing is relative weakness. I'm going to pull up, I know Aaron mentioned GIS earlier, General Mills, and you look at this huge move down, but I want you to take a look at their relative chart. GIS, first of all, is in with the food products group, which over the past couple months has been horrendous. And GIS, relative to its peers, has been horrendous. So you've got GIS, which is trending lower versus the S&P 500. Again, if I'm trying to beat the S&P 500, how am I going to do it with this move to the downside? Finally, you can see the food products index relative to the S&P 500 continues to move lower. So I'm in a group that is not performing well, and I'm one of the weakest stocks within that group. That's not going to be a great stock to be in. And you can see when you start breaking down on a relative basis and volumes picking up, what's the point in holding? I mean, I know a lot of you are probably thinking, well, pays a nice dividend, it's got a long-term chart, and maybe from a long-term perspective, you can try to find value in it. You're going to hold it for a long time, and you're not worried. As a trader, this would kill me to lose this kind of money in a short period of time. So again, for me, I don't want stocks that show this kind of relative weakness. And with that, let's summarize what we went over today. And you can see all of the number of reasons to sell. You might be wondering, well, why would you sell? Well, there's 10 of them right there that we just went over in this session. So hopefully it's been something that maybe will click with you, particularly if you do follow the market more on a short to intermediate term basis, and hopefully will save you some money in the future.
Yep. I did have a few questions for you from the room. I thought I'd throw at you. One was that when you make your sell decisions or when you trade, do you do that intraday? So do you make, if something's showing up intraday, do you go and sell, for example, a reversing candle, or do you wait until the close?
Great question. For me, in a bullish environment, a low VIX environment, I use closing stops because I'm not worried about the market getting away from me because the market's not expecting a lot of volatility. In a high volatility environment like now, there's no way I'm using its closing stop. I mean, these stocks can get away from you so fast to the downside. Now, it does, mean that you might get whipsawed. If you have anytime you have an intraday stop, you're subject to whipsaw, but you're limiting your loss, which I think is really important in a volatile environment. So that's my strategy. I almost always use closing stops, but when I get into an environment like we're in now, I would use intraday stops. Again, you can get whipsawed, but you also can save yourself a fortune if the market goes into a free fall.
Exactly. And we have those stock charts price alerts. You can always set up to help you with that too if you can't watch the chart. The other question was reversing candles on weekly charts. Do you use that for sell signals, or could it be translated in your opinion?
I think they're still very important, but keep in mind the market closes 5 times each week. So, from a reversing standpoint, from a short-term basis, if I'm looking to sell and it's a Tuesday and I'm getting a reversing candle on a Tuesday on a daily chart, I'm not going to wait to see what happens on Friday, because from a short-term perspective, again, things could be completely out of whack. I could lose a lot of money from Tuesday to Friday. So, if I was more of a long-term trader, I think that's probably a better strategy to use weekly instead of daily, but I'm not long-term.
All right. Well, I think that covered really the majority of those questions, but when I'm doing my sentiment update at the end, feel free to go lurk in the chat room and answer whatever we may have missed here. So,
all right. Or if I don't get to your questions, I am getting copies of those questions sent to me, so I'll try to respond. If if I have your email, I should be able to respond to you.
Right. All right. With that, I guess it's time for the 10 and 10 to 1. If you're ready for that to start, let's see. All right, so here we have our 10 and 10 requests. We had about 30 of them, so 2/3 of you are going to be disappointed. Go ahead and like any of these in the chat room if you're watching live, and the top vote getter will make the 10 and 10. So I'll be watching that closely. But our first stock, I guess I can show you guys the RRG of this since we usually do that. And we'll just look at the weekly one for now. So kind of a mess there, jumbled mess when you've got 30 to look at. But the main thing is looking at what you requested. I mean, a lot of them are in the leading and improving categories. So I usually like to choose some from this category, and I do mix it up as far as sectors. So that's how I do make some of the choices. And then we look for those northeast headings on here too, showing us that things are improving. So even if it is in the weakening category or in the lagging category, if it starts making that northeast move, I'll be looking at that more than likely. And with that, go ahead with CIEN. That's our first one.
Okay, well, let's take a look first at the relative chart. And here with Sienna, what you can see, I've got mixed feelings about Sienna. Number one, we did, again, reverse at longer-term resistance. So we just talked about that. Here we tested it. The very next day, put in a bearish engulfing candle. So as a trader, if you're in it on the move up, to me, that's a kind of a hit over the head that maybe it might be a time to take some profits and move to the sidelines. We have since moved back to test rising 20-day moving average. In a low volatility environment, I'd be all over this right now to buy. And I'd probably use two entries. I'd probably use the 20-day and then what I consider to be very significant gap support around 2460. Those would be the two levels. Personally, I'm not going to buy it, and it's on my strong earnings chart list. I love Sienna, but I don't like buying in a market where we have been breaking down and the volatility index is shooting up into the mid-20s. I need to see the market calm down a little bit. So I wouldn't buy it because of that reason alone. But otherwise, I do think that it's one of the better performers. I think on a relative basis, you'll see that Sienna is outperforming its peers in 2018. It's outperforming the S&P 500, and the group itself has been outperforming the S&P 500. So I think you got a great stock in a great space in a horrible market. And I say horrible market short term. I'm still bullish long term, but the hair on the back of my neck goes up when the volatility index rises like this.
Yeah, I can understand that. All right, our top vote getter, NVIDIA, NVDA.
Yeah, I mean, on a relative basis, I think NVIDIA is holding up really nicely. I don't like the fact that it has broken down what I would have considered to be a pretty solid ascending triangle. That would be maybe my biggest concern here. I think eventually it'll probably work out just fine. But here, I mean, depending on how you want to draw your line, that to me is your ascending triangle. We've broken down. Today's volume is very heavy, by the way. So I think how we close today is going to be important. What we could eventually see is maybe something like this, where the ascending trend line or the lower uptrend line is just at a little bit less slope, and price continues to move down. And perhaps we get down to challenge that low candle body, or even perhaps that tail. So somewhere in this area maybe would connect. But right now, again, I'm gonna be sticking for the most part, given the breakdown yesterday and the high VIX level. I'm playing it safe, and I'm just kind of watching right now.
Okay. Let's see the next one for our Canadian friends, TOU.TO. And that would be Tourmaline Oil Corp.
Well, let's see how this rally or finishes today, but I don't like that candle right now. We just got done talking about overhead resistance and tails and false breakouts. And, there was off of this downtrend. Here was your reaction high, twice double top just below $22. Today we get up to $22.26 intraday. And here we are at 21.50 or 21.52. If we could rally later in the day, we got good volume today. If we rally and get back up above that 22, I'd be more bullish. But if we finish where we are now or lower, I would be looking maybe for a return back to the rising 20-day.
All right. The next one, also somewhat popular, GDXJ, the Vectors, the VanEck Vectors Junior Gold Miners.
Yeah, I wrote about this morning. I mean, the one positive with all this volatility is usually gold is in favor when fear comes into the stock market. It wasn't necessarily the case back in February, but historically, when the market is fearful, gold tends to be a safe haven. So in the short term, again, this is short term, I'm a fan. As long as the volatility stays up, I think that the gold and the miners and so forth will probably find a home. Traders will be looking for this kind of a trade. But longer, further out, I would be careful if, for instance, and you can see we gapped down. Actually, I could probably go up just a little higher. We gapped down from about 3360 in February, came back up, filled the gap, and it seems like we're making our way back up. What I would be concerned about is if you get above 3370 or so, maybe get up to 34 intraday and fail with the similar looking tail on the VIX. That would make me want to maybe move back to the sidelines. But otherwise, right now, this is probably one of the best areas with everybody, with fear escalating again. I think this is one of the better areas to consider.
All right. Next one, Best Buy, BBY.
All right, BBY. Well, you can see it is moving lower, continuing to trade under the 20-day. I think that the chart looks very bullish. So this is a stock that I certainly would consider when I'm, feeling more comfortable about the market. There is your resistance going across. Here is your reaction low to the downside. So a similar looking candle where you get this breakdown below 66 intraday and a recovery back up above with maybe a similar reversal, or actually an opposite reversal in the VIX, where you're moving up and then you reverse, come back down in the VIX that day. That could be a signal for a short-term trade in Best Buy. So I like it, but again, I'm watching it for right now.
All righty. Let's see, the next one is going to be EEM, and this is the Emerging Markets ETF by iShares.
Okay, well, risk right now is going out the window, and so I'm not shocked by seeing the emerging markets struggling here over the last 2 days. We've seen a $2 drop, which is about roughly 4% in the last 2 days, and we are approaching a pretty key short-term support level at about 47.25. So for me, I would watch that level very closely. Again, I'm not going to take chances in this market. If we fail to hold this level, 47.30 or so, on a close, I would be fearful that we're going to drop another couple dollars to challenge that early February low. So I'd be careful with it.
Okay. Next one would be ENB, Enbridge, pipelines industry.
Yeah, energy's actually been holding up, and I know the pipelines have been holding up. So I'm going to, because this one is so weak, I'm going to bring up the relative chart. Let's see what this is telling us. First of all, big breakdown. I mean, it's kind of hard to paint a bullish picture when you see a stock that's gone from 40 down to 30 in literally just the year to date. So it's been a huge underperformer. You can see you can see the pipelines have been moving lower as well. I thought this group was doing better this week, but maybe it's the other areas of energy. But anyhow, ENB relative to the group. So the group's not performing well, and ENB on a relative basis is not performing well. ENB obviously versus the S&P 500 not performing well, and the group relative to the S&P not performing well. So if I'm trying to outperform the S&P, this is one that I would not be interested in. I think you've got a chance, perhaps, I don't know if this has a positive divergence because I don't have a PPO on this particular chart, but if we do, maybe at some point we have a shot to get back up. And by the way, look at that shooting star candle right off the top. That was the breakdown level, about 33.5. It looked like we were going to get through, failed, and then look at the next day, the selling. That was a reversing candle right at price resistance just before we had a huge sell-off. So these candles do matter.
All right. Next one, iShares Silver Trust, SLV. I'm looking at like, I can kind of make a case for a reverse head and shoulders after that gap in September.
Oh, yeah, I'm not a fan. We continue to trend down. I think the line in the sand to the downside is fairly clearly marked. I think if you get back below about 1528 or so, that's a big problem because you've had 3 moves back down, and I'm looking at maybe more of a descending triangle here off of a downtrend. So I don't know. I mean, there's different ways you can look at it, but if we go back over the last many months, you can see that this has not really been doing very well, hasn't been doing much of anything, while the market overall has been doing very well. So again, as an alternative to the S&P 500, I don't think so. Not for me. So I would pass.
All righty. Next one, GlaxoSmithKline, GSK.
All right, GSK. I think we got 2 more here.
Yep.
GSK, major resistance level coming up. I like the volume coming in, but I still would be very careful with this resistance right there. You can see that massive selling, over 20 million shares that began at about 38.50. Look at the false breakout, the tail going up above that resistance level. Couldn't do it. And it was a bearish engulfing candle too, by the way. We had one more day of strength, but we didn't take out that intraday high, and then the selling kicked into the downside. I would be watching this. Again, this is one of my strategies. If I was in, I would be a seller as you get to this resistance level and let GSK show me that it can make that breakout.
All right. And the last one I have is, let's see, Westrock Company in the materials sector, WRK.
Well, we've rolled back over. There's a double top false breakout. I don't make this stuff up. But there it is. I mean, here's your move lower. Here's your reaction high. And by the way, here's a breakout. Pretty good volume. Negative divergence. See that higher price, lower PPO, reversing candle. There's your bearish engulfing candle, and then continue movement to the downside. Now what we have is a reaction high. We pull back, double top. We actually moved above that level and failed. See how we closed back below that resistance? Not a good sign. Now we're working our way back down. I think we're going to head back down to test this 60.5 area. I'm not interested.
All righty. That is the 10 and 10 to 1 complete. Here are your symbols, and we will get those up after the show as soon as I can on a Friday. And with that, I think it's time to move on to ChartCon. I wish it were very soon because I can't wait to do it. All right, you should be seeing either my screen or the link to the ChartCon page. So in August, we're doing an online conference, Reducing Risk in Uncharted Waters. So this should be a great conference. It is online, so you don't have to travel to Seattle. You can watch it from your comfort of your own home, as they say. But if you really want to enjoy it on a different level, we still are taking VIP reservations up through March 31st. So if you want to join us, there's 2 packages available. And here are all of our guests that will be speaking. So you'll get to meet all of us that are there. And in addition, you can also sign up for a VIP cruise. And then you get to go to Alaska with us. And we have a lot of special programs set up. And personally, I think it's a great summer vacation. So, and that includes your significant other. So for that price. So definitely think about it. I think it would be a lot of fun, and we would be happy to meet and talk to you. So there we go for that. Let's go ahead and get into our final market update.
Yeah, I think that whole managing risk topic is so important. I mean, we just talked about selling and how it's important to manage risk. This is going to be not just from a short-term trading perspective, but you've got a lot of different speakers that are going to talk about risk in a lot of different ways. So if maybe what I just went over didn't appeal to you because maybe you have a little bit longer term horizon, you're going to find plenty of speakers who are going to fit your trading style. So I think it's really important to be able to look at different mindsets and the way everybody approaches risk, how they manage it, and then maybe you can fit it into your own trading style. So yeah, ChartCon's going to be huge, and it is the best trading conference out there, bar none. And I'm not biased. It's fact. I've been to a number of them. Most of them are sales oriented. This is information and knowledge oriented.
Yeah, we're not trying to sell you anything. We're just telling you how to avoid risk using technical analysis. So I would hop on that if you haven't already. And you do get to keep the recording and you can look back on it. And again, if you come join us, I mean, I can't wait to do it myself. So I'd love to talk to any of you who happen to be going to the conference. So with that, I'm going to go ahead and put in our market update candle glance. And as you can see, not a great day on the markets. You know, we were moving sideways for a little bit, consolidating sideways, and then we lost it. But we're now flirting with intraday lows. we could see a bounce off this level, but everything has been quite bearish. And when you look at a VIX that is now reading almost above 24, it did today, that is cause for some concern. TSX traveling downward the majority of the day. We can see USO gapped up and is now curling over, though, having hit an intraday high. And UUP and gold. So you've got the gap down on gold on UUP, and it's starting to travel lower. And the opposite is true, inverse. Gold up on a gap, and now it's been trending higher, but it seems to have hit some overhead resistance here just above 128. As I said, VIX ahead, almost at 24. I wanted to show you sector rotation as part of today's coverage. And Zach, I don't know if you're able to let's see, magnify this a little bit, but I wanted to let everybody know we've been talking about sector rotation, and here is the cycle, mid-expansion, capital goods, materials doing well. I'm a bit concerned because we are seeing energy at a bottom, and we need to, if we see energy start to do well, we know we're kind of in the late stages. Healthcare would also be one to pay attention to. And of course, then you move into that contraction and you have consumer staples, utilities. So I wanted to show you this so that I could also show you, let's see if I can get to the right page here. I have an RRG here set up. I thought I did that here. Yep, there it is. So this is the 1 year weekly. Okay, so over time, when you're looking at it on a weekly basis, technology is leading. Financials, though, have started to move down just a bit. But I think the really interesting chart is the daily version of the RRG. So this is the much shorter term. And look at what's happening. You've got energy improving. You've got gold, a defensive area. You have utilities, which have been doing very poorly, and those tend to do better in a more of a bear market situation. As I said, that's where it starts to go. So to see some of the, see technology weakening to this degree, financials in the lagging category, materials in the lagging category, those are things that should be worrisome. I know we look at a lot of the relative, price relative, and I know you've looked at that as well, Tom, but at this point, I'm starting to get a little nervous. I'm thinking the sector rotation might be starting to shift, and that gives us great pause, especially when you're looking at a market chart like this for the SPY, where a double top has now executed. If we get the close under there, it will have definitely confirmed that pattern, and that would take us down certainly to test those February lows. And the concern I would have would be if we get down there and have difficulty holding that area, it could be really not good. And already, of course, we're feeling the pain as we do appear to be going down to test those February lows. And with that, go ahead.
No, I was just going to say, I would, in the short term, I would completely agree with you. I think that clearly money is moving away from aggressive areas. We got the volatility on the rise, and we actually saw the Dow Jones go down earlier today and test the that early February low on a candle body basis. But from a longer term perspective, if I'm trying to address the health of this market, I would not use a 7-day pullback. I mean, that was a 7-day RRG.
Right.
And when the market pulls back, it's very normal for gold and the REITs and utilities and so forth to lead to the upside. So I think that I don't think the time frame is long enough to make a long-term call on the bull market. What I would, because I think it's more of a process. So I would be looking for months for this type of rotation to occur as opposed to days.
Right.
So that, I mean, yes, I'm very concerned. I agree with you. I'm very concerned about the near term because of the spike in the volatility and the fact that a lot of these aggressive stocks are being thrown out the window. But I wouldn't use that to make a long-term call. That's my only point.
Right. Yeah, I mean, and when you take a look at the RRG on a weekly basis, technology is still in the leading category. I do worry a little bit. Financials taking a little bit of a hit, and gold improving to such a degree like that relatively over the last 3 years, a monthly version. At this point, I agree with you. And, the concern is, as far as the daily over that 3-year or 1-year time period, that's where I get a little bit concerned. So, it'll be interesting to see. But you can see the tracks. You can always increase your tracks to see where they've been going. And of course, you can animate it as well. So something to keep in mind for sure.
Yep.
And with that, I think I'm going to go ahead and move into the sentiment report. And there we go. I'll go ahead and close that. All right, so I'm going to show you, we're going to first start off with the put-call ratio. So a reminder, I look at sentiment. Sentiment is contrarian. So when everybody is very bearish, that's usually when you're going to get that market turn. And when everybody is very bullish, that's also a point of a possible market turn to the negative direction. So I like to pay attention to what's going on in sentiment, because sometimes it can give us a little bit of notice that there might be some problems going on under the surface. So first of all, I'm going to look at the put-call ratio. And I will tell you that when I looked at most of these sentiment charts, they are really mostly neutral. We're not seeing any climactic moves. We're seeing readings sort of in the middle. But what I would note on the put-call ratio chart is we are starting to see that equity put-call ratio rising somewhat. And high readings mean that we're getting more bearish. So that's actually a good thing. But it's not enough at this point. I'm just not seeing enough of an improvement here to get too excited. We need to start seeing it becomes very important when we start reaching these tops and these higher readings. We're still really middle of the road as far as the readings. So honestly, as far as the put-call ratio goes, I would say it's neutral, but we're getting a little bit of rising bearish sentiment going on there. So we want that. We want people to get very bearish. That's what'll set up our significant market bottom. That's what I'm looking for. And right now, it's just not that bearish. And here's a good example of that. This is the AAII poll, American Association of Individual Investors. So this is pretty much all of us. And here we go. So you can see that bulls have been pulling back as far as the poll is concerned. And we are getting a slight increase in the bears, but really not that much when you look at where we were. Notice this high reading on the bear poll back here, and that came in, of course, after this large decline. Well, we got that climactic reading, and then we did see a bit of a bounce after that. So I do pay close attention to these, and of course, you can see here where we got that excessive bullish, those excessively bullish readings. That was telling us that we should beware, that there might be a decline on the way, and sure enough. So at this point, though, when you're looking at a bull-bear ratio close to 1, that's pretty much even as far as sentiment. And then if you add up the amount of bulls and the bears, right now we're seeing a third of the pollees in neutral with no decision one way or the other. So that also is a little bit of a concern. That's showing some bearishness, in my opinion, because we have been in such a strong bull market. We're losing some of that bullish sentiment. We're increasing some of the bearish sentiment, but clearly the neutrals, are starting to expand somewhat as well. And I find that it's bullish if we can get everybody bearish, but right now it's just, we're sitting in neutral, unfortunately, not very helpful. As far as the name exposure index, this is the National Association of Active Investment Managers, and we follow their exposure to the market, and we watch for these spikes. And again, typically when you look at this spike, this was the highest reading we had seen, oh my goodness, in years, if I recall. We had not seen an exposure rate that high. And again, warning that there might be some problems on the horizon. Of course, we still ended up moving much higher, but notice what happened when the exposure pulled way back after that near the top. You can see it right here, just coming back in even before we had that decline. So we were seeing that excessive bullishness. They were all in, and then they started to pull back their exposure. And I think that was also a warning sign. So that's why we pay attention to it. And right now, unfortunately, those readings are kind of middle of the road. I don't think it's telling us that much. I've marked it here, and you can see while it is somewhat elevated in comparison to what we've seen over the past year, it's pretty middle of the road. So unfortunately, I have to read this one as mostly neutral as well. I did want to show you the Wall Street Sentiment Survey. Right now, the poll sitting in the chat room is going to ask you what the market timers are asked every week. Is the market going to go higher or lower the following week? And you can see, interestingly, a lot of bullishness about this week and what ended up happening this week. Not the best. We've been struggling here quite a bit. So again, sentiment being contrarian. That's what we're looking for. Highly bullish, lots of bullishness, likely to get a reversal to the downside. Excessive bearishness, likely to get a reversal to the upside. The last one I'm going to look at is the RIDEX ratio chart. RIDEX had a basket of bull funds, bear funds, and then they track money market. It's now all under Guggenheim, but we've left the RIDEX name because we call it the RIDEX asset ratio, and it's just, we're paying homage back to RIDEX. And so we follow the cash flow in and out of the bear funds, what the assets are, and we can tell when we're getting, you know, a movement into bear funds. We can tell if we're getting a movement into the bull funds. But also, I think it's very interesting, we also get the assets in the money market funds. So it gives us a really good picture all the way around, in my opinion. So when I was looking at these, I put the arrows in because it's maybe not so clear here, but I wanted to point out in the thumbnail so it's a little easier to see. We did, since last week, we've gotten a rise in the bear fund assets. So we've found some more interest in the bear funds, not as much as we've seen in the past. So again, starting to move more into that bearish place. You can see that money market funds assets have started to increase somewhat. And again, I think you combine these two, it's showing some bearishness among participants as far as their money. And of course, we have this drop in the assets in the bull fund. So, you know, that I'm sure is partly due to the loss of, you know, value we've seen over this decline. But the main thing is seeing what's going on, where's the money going and where is the money coming out. And currently we're seeing bearishness. We're seeing rising bearishness, but we're not seeing the kind of readings that I would be looking for before you get a big market turn. So at this point, we're seeing everybody moving a bit more bearish. We want to see everybody get very bearish, and they're not there yet. And so let's go ahead and recap what we've talked about here as far as our sentiment. And there you go. We have the 10-day moving average of the put-call ratio. As I said, neutral, and yet we're seeing a little bit of rising bearishness in those ratios. AAII neutral, you know, the ratio is near 1. 1/3 of the folks are neutral. So it really isn't telling us too much right now. And then we have the name exposure. We're seeing slightly less exposure. So we got a little bit of bearishness showing, but ultimately the exposure is still on the high side. We're seeing readings that certainly aren't showing excessive bearishness toward the market, but it's somewhat bullish for the market when you see the exposure pulling back when they're getting a little bit more bearish. And then, of course, we're seeing the same thing with the RIDEX ratio, that there's a clear decrease in those bull funds. You're starting to see the addition into the bear and money market funds, which suggests we're getting the participant traders and participants are starting to get a little bit more bearish. But it's still, I would read it neutral to maybe somewhat bullish for the market. Overall, though, like I said, as far as when you wrap this all up, pretty much neutral. We have that slight bullish bias, which gives us, which is actually kind of slightly bearish for the market. So, you know, when I look at it, it's mostly neutral. I just don't see that we're getting what we need to get. And actually, I would say this needs to be switched because we see a slight bearish bias, people starting to get a little bit bearish. So that would be slightly bullish for the market. But as I said, overall, I think the word to pay attention to here is neutral. We're just not getting the information we need from sentiment right now. We don't see any extremes, and that's what we look for in sentiment. And so that would be the wrap up for sentiment. And I know we have a few minutes here left, maybe to answer some questions that we had or any comments or that you might have had, Tom, as you looked through what was going on.
Yeah, I've got a couple of charts I was going to show. First, I wanted to start with the NASDAQ and just point out that on the NASDAQ with today's low down at 7,100, we actually got down to 70.96. We have gone back down and tested the early March low. We haven't put in the double bottom from where we were in early February, but the NASDAQ has hit what I consider to be a pretty significant short-term support area, and it's trying to bounce off of it. Now, the other thing to keep in mind is that on the very short 10-minute chart of the NASDAQ, you can see that when the selling kicks in, a lot of times when the volatility is on the rise, sometimes you get the selling that takes place in the afternoon, like we saw yesterday, where we get almost no bounce. I mean, the NASDAQ fell from 72.85, that area, down to 71.70, about 115 points in 2.5 hours with not much of a break to the selling. And saw the same thing in the down, really all the major indices. But that's something that can happen. I'm not saying it's going to happen today, but it is Friday. The market's nervous. Volatility is still up there. I'm really nervous about this market this afternoon, given the fact that we are at some key short-term levels, as I just showed on the NASDAQ. Also, I'll pull up the NASDAQ in the 60-minute chart. And when we had the big selling at the beginning of February, notice anytime we got in a little bit of an extended move to the upside and we started feeling good about things, it was the 20-hour EMA that where we struggled before we would roll back over. So looking at what we've been seeing now since really about the 12th or 13th of the month when we topped up here on the NASDAQ, we have really struggled every time we've gotten to that 20-hour EMA. That currently is up at about 70, well, it's at 72.35. So if we're looking at 7,100 as support on the NASDAQ, I think 72.35 is going to be a key resistance. And that is a trading range that I would watch. It's a volatile, it's an area that's pretty wide in the near term. I mean, I wouldn't be surprised later today if we're over 7,200, but I also wouldn't be surprised if we're at 69.50 or 7,000. So I think that's the kind of market, unfortunately, that we're in right now.
All right. Yeah, and I'm looking at some of the questions, and as far as the RIDEX funds go, those are available and easily traded out there. So you do have a mixture of, the professional investors, but I think you would probably see a bit more on the retail investor side. So that was one of the questions we got. So weekly schedule, what's coming up next week? Everything stock charts on Tuesday. Mark Young from Wall Street Sentiment Survey will be here to talk sentiment with us, as I just talked sentiment. Arthur Hill will be here Thursday to give us his latest views on the market. And Friday is a holiday, so we will not be airing the Market Watchers live show.
There you have it. And I would just close by saying, anytime you get into a high volatility market, you have to be very careful. For me, it's like, to give you an analogy, it's driving down the road and having an emergency vehicle coming up under, from behind, where by law, you have to pull over.
Right.
And wait. And that's the way I look at the market. When I see the volatility index moving up into the 20s, to me, it's like that emergency vehicle saying, you better move over to the side because, otherwise I'm just going to run you over. And
right.
That's kind of what the volatility index tells us. When we get that high volatility environment, you just have to be careful because the selling can be very swift, as we saw yesterday afternoon, and as probably everybody can remember from early February. So this afternoon will be interesting, and obviously in the next week as the market tries to deal with some of the fear that it's facing right now.
Mm-hmm.
All right. I want to thank everybody for being with us. Please remember to complete the survey as you exit. We do really enjoy getting your feedback, and I'd love to know what you thought of the Reasons to Sell workshop I did earlier today. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe, and hopefully we'll see you back here on Monday. Happy trading.